You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks again for having me.
It looks like our central bankers are dead intent on making sure we have inflation, but you're saying they're going the wrong way, and no matter what they do, we're marching to a different drummer, and deflation is actually the tune that everybody's singing now.
Jim, I've been singing the deflationary tune since 2000. You know, if you back up and look at the hard data, the stock market and the economy peaked in 2000. The secular bull market occurred, as I've said all along, in 2000. And the underlying economy peaked in 2000. And and it has been deflation that the central bankers have been fighting ever since. If you just think about it with a little common sense and look at their feet, so to speak, instead of the words, or even the words these days, but, you know, the mere act that they have done all of the liquidity craziness that they've done with all the QEs, and even before that, you know, the stuff we saw between 2001 and 2 and into the 2007 top, you know, all that liquidity campaign was about fighting deflation. And people tend to forget that. I think it's easy to lose sight of that. And what happened, like I said, I have an article coming out and I titled it Deflation, and I have 3 or 4 charts in there showing people how and why the stock market and I think the economy peaked in 2000, and why and how, and I apologize for the cough, I'm getting over the flu, but how the rally out of the 2002 low was a rally that occurred within the context of a secular bear market, even though it went to a new high. I know that people are programmed to think that, you know, just because you're at a new high, that maybe you're not in a bear market, and that's not true. There's examples of that in the past where you've seen new highs. I mean, everybody knows about the 66 to 74 bear market, and there was a period there in early 73 where the market actually moved to a new high before collapsing 46% into the final bear market low. So, you know, we've been told what to think on that front, and you can't necessarily equate a new high in the stock market to a secular bull market. So anyway, as we came out of the 2002, the natural 2002 4-year cycle low, the reliquefaction campaign, you know, was in full swing. They drove commodities into a bubble in 2008. They drove housing into a bubble in 2005. And one by one, of course, the bubbles pricked. And then finally, in 2007, we saw the top with equities. And I said all throughout that time that the longer the rally extended, the statistics suggested that the worse the decline would be. And that is precisely what happened. It resulted in the worst financial collapse since the Great Depression. And then if you think about it, what was the answer to that? More of the same thing, but at a greater scale, I might add, as to what created the worst financial crisis since the Great Depression in the first place. More liquidity, more pumping, more fighting the deflation. And coming out of that low, I did not think equities I didn't dream equities would hold up as long as they have. I said that the rally would continue until we got the setup with the DNA markers, and then, the second or the third phase of the bear market would continue. And, in the process of the rally out of the late 08, early 09 low, depending on, if you're looking at which commodity you're looking at or equities. Equities this time did move to a new high and they stretched further than we thought, but commodities did not. And so the way I read that is they got, the bubble this time it didn't stretch across all asset classes like it did before. They got less bang for the buck. A lot more, ammunition was fired, but there was less results. And this time, like I said, it didn't spill over into housing like it did before or commodities. And the stock market is it. And I think that people look at the stock market and they tend to think that everything's okay because the stock market is high. And it's at a new high. But that is absolutely not the case. This has occurred, like I said, no question in my mind, within the context of a secular bear market. I think what we're seeing in oil is going to come to the equities market. Once we get the setup in place and confirmed, then, I think it'll be checkmate. And at that point, there's nothing they can do. I mean, once the DNA markers are in place and the I's are dotted and the T's are crossed, I mean, at that point, the die is cast and it's done. Just like it was done with oil, last December 2013, you go back and look at that letter, I said that the CRB at that point was set up for lower commodity prices. It had peaked out just like it did back in 2008. Well, in that case, it didn't just fall completely apart. It just commodities kind of treaded water during 2014. And then in late summer, they started to come unwound. And then by fall, things was really coming apart there. But, all in all, Jim, it is deflationary. It's deflation that they've been fighting. And, there is a deflationary spiral coming. No question about it in my mind, based on the data, in equities. And in the article that I have coming out, titled Deflation, I show people hard evidence that, it's just indisputable evidence of this. I show the volume behavior characteristics of the stock market from the 82 low into the 2000 top, and it's clearly bullish. Not coming from my words, but from the definitions of our volume characteristic definitions from Edwards and McGee, which is a very reputable technical analysis book. It's one of the books actually they use for some of the technical certification programs. And it's just a definition straight out of their book. And if one follows along and looks at the chart, you can see how the characteristics of volume changed at that 2000 top, and how everything since then is characteristic of a secular bear market, in spite of the fact that we're at a new high. And again, the reason we're at a new high is because of the liquidity infusion, which is only serving to make matters worse, not because of a strong economy or because of us being in a secular bull market. And then I show there were some charts last year floating around the internet that got a lot of popularity, and one of them was the velocity of money, and one of them was the job labor participation rate. And so I took those charts, and those are good measures, if you will, of the underlying health of the economy. If you have a strong economy, you have jobs, and if you have jobs, you have the velocity of money. People are spending that money. They're turning that dollar over. I'm buying a car. The salesman's buying something with his money that he earned from his commission, and that guy's buying something, and that dollar is turning. Well, the velocity of money peaked back in the late 90s. The job participation rate peaked, and the stock market peaked, all in the late 90 to 2000 time frame, late 90s to 2000 time frame. And that's what I'm saying. Everything, the economy, the secular bull market, everything peaked then, and it's deflation that they have been fighting. And these job participation charts, the stock market volume charts, it all shows that, if you want to just stop and look at it.
We'll have more with Tim Cyclesman Wood right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, I know in the past so often when deflation is rearing its head and economies are in trouble, so often governments, it's sad to say, look to war to take people's minds off it. Is that why we always see so much war mongering going on? Is they want to divert our attention away from the economy?
Jim, I really don't know on that. I don't know. That's outside of my realm of expertise. I know that there are some strange things going on in this world with, the boogeyman, which, I question some of that, the war on terrorism and ISIS. And it's just constantly something. You have the, what was it just this past week? We had the thing in France, and then we had, the thing going on with, what was it with, security breach or whatever, the internet system or whatever, computer systems hacked. I pay none of that any attention. It's just always something. I try to look at the charts and just go by the charts. And I will say this, on that note, when you look at a chart, and I know this may be a hard concept to grasp, and people just have to take this at face value and run with it. But back in 2000, we had the top. It set up, and the market started down, and the market had been going down. And then came 2011, and, the market ultimately moved lower into the 2002 low. And out of that low, we had the extended move in the 2007 top, and then it kind of quietly set up. I remember people kind of taking me to task about, no, we had the 4-year cycle low in 2006. We're in a new 4-year cycle and everything's good. And I'm like, no, we're not, because of the DNA markers. And I said that because this thing is stretched, it's only made matters worse. And then after it got going, all the skeletons came out of the closet. We had all the banking issues, and we had, all that's, everybody remembers that, all the failures and the bailouts and so on and so forth. And so my point is that once these cycles set up, just like after it set up in 2000 at that top and got going, there came 9/11. After the 2007 top set up and the cycle rolled over, the bad news appeared. After the cycle got underway and was set up, it set up quietly, and then it started down, and then the bad news appeared. And I'll say this, it's just a matter of history. You don't have to have a crystal ball. All you have to do is look at the cycles and look and see what happened. But, this thing is stretched. Like I said, I'll go so far as to say this, that because it is stretched so far outside the norm, this is the longest 4-year cycle advance since the inception of the Dow Jones Industrial Average in 1896. We have never seen not only an extended 4-year cycle of this degree, but we have never seen such manipulation. We have never seen such a smoke and mirrors advance ever. And then combine that with the fact that it's occurred with a contracting economy and within the context of a secular bear market. And you have the absolute perfect storm waiting to happen. And what I'm trying to say is once this thing set up, or let me back up, I lost my train of thought. So for all those reasons, I say that this is the most dangerous market in U.S. stock market history ever, since the inception of the averages. And so what I'm saying is once we're set up, the I's are dotted, T's are crossed, then, I don't know if it's going to be war, terrorist attacks, Ebola. I don't know. You can't even guess these days. The news is so crazy. But there will be something. And the statistics associated with this, the extended cycle, with the phase 3 of the bear market decline, and on and on and on, it will be fulfilled. The cycle will express itself, and it will be associated with negative news. What that negative news is, who in the world knows? But there's something out there.
And Tim, you've explained in the past as well, you don't make your newsletter or your research letter reflect what's happening in the news. You don't watch the TV.
I don't. I really do not watch the TV. And to give people a couple of examples, I know that this is a difficult concept to grasp for people. But just like with commodities, and you get the letter, you can vouch for me on this, and if someone wants to take me to task, it's in print, it's in the letter. Last December, I said that the 3-year cycle in the CRB was set up, looked like that we had the top and that we would operate under the assumption that we had. We had no choice to because of the data, and unless something changed, and nothing ever changed. So, and then, as we moved into August of this year, we got further confirmation. The market, commodities, they didn't go anywhere. They just kind of flatlined, during that time frame, that 8 months. But we got further confirmation, and I addressed it again in the research letter then. And it set up, and then it starts easing down. The market, or commodities start going down. And then in October, November, whatever it was, the Saudis came out with their announcement and just accelerated the downside. Kind of like back in 2000 at the top in equities. It set up in January 2000. S&P set up in March, and the market had already rolled over. It already started down, and then mysteriously, after the cycle was set, whatever that piece of news was, it came out, and it forced the market. It forced the cycle to fruition, and it's always that way. The first time I ever saw that was back in the 80s at the Chernobyl thing, and I had just started looking at and studying technical analysis, and I remember the guy was studying it under an older guy. I was looking at soybeans, and I'm like, man, soybeans is making a cycle bottom. This thing is basing up to go up, and the charts were reflecting that. And then here come the Chernobyl thing, and back then there was this big deal where, you know, the U.S. was dependent on soybeans from Russia or something. Anyway, it had an influence on the market, and everybody was worried about it. One of those things that passes in time. But anyway, the Chernobyl incident fueled soybeans and it made them rally like crazy. And the same thing, the next time I observed that was when Hussein invaded Kuwait. Oil based up, made a bottom. You could see it basing. You could see the cycle bottoming, and then it kind of starts easing up, and then next thing you know, here's the piece of news, and the cycle is fulfilled. It's like that, and so I know from history how stretched this is, what a fake market this is. I know that the statistics are going to be fulfilled. I know that it's overextended. I know that it's going to snap back, and I know that there's some piece of news out there that's going to make it do it. What it is, I don't know. It's not going to occur at the top. It's going to quietly set up. Everybody will think things are fine, and then it'll start easing down, and there may be a little bit of panic, and then something. Then, as it starts down, the cycle is going to force, the skeletons will come out of the closet, and it's going to force the news will then force the acceleration into the low.
Tim, thanks a lot for chatting with us.
Jim, thanks for having me. Let me add, if anyone wants to look at, you know, the hard research, and it's just data. I mean, it's indisputable, hard facts. And if anyone wants to look at that research, you know, it's available in the research letters at Cycles News and Views. And I encourage people, please don't be blindsided by this. I can't express how bearish I am longer term, but it's the setup that we're watching and monitoring to see, excuse me, to see it fall into place, and then once it's in place, I think it's going to be pretty brutal.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.